Hi, Ben Kingsley here with my economic and RBA update for the month of December. Yes, the last month of 2021. And the key themes for this month include, yes, we have to talk about Omicron, the new variant. We've also got September GDP data that surprises on the upside. More on that. RBA is talking cryptocurrencies, so a lot to share there as well. And then finally, has the property market lost its bull mojo? We're going to get into that as well. So let's get into it as we start to look at some of the data. Let's talk Omicron, the new variant that has appeared in Africa and is now obviously spreading around the world and looks highly contagious. And I want to have a look at the economic impact that we are seeing from that, because markets are obviously a little bit scared by this new variant because there's a lot of unknown information. So to do that, what we want to talk about is the OECD report, which was released last week on the back of this news. So they scaled back the forecast for their global GDP by 0.1%. Now, that's not a big change considering that they're still forecasting 5.6%. But it has also meant that the adjustment is around the Eurozone and China coming off, but the US and Japan are obviously being topped up in terms of where they set. Now, this is where it becomes quite interesting and a little bit of somber reading here for some. In the report, the OECD warned that Western governments could be forced to bring in fresh emergency financial support for businesses and households if the Omicron variant causes a severe global slowdown. The OECD said that renewed wave of the pandemic threatened to add to the existing strain on the world economy from persisting high levels of inflation. The OECD chief economist said there were two scenarios facing the world economy as Omicron adds to the uncertainties around the recovery from COVID-19 crisis. One is where it creates more supply chain disruptions and prolongs higher inflation for longer. And the other where is it's more severe and the governments do need to impose more mobility restrictions and in cases of declining pressure on inflation and the overall, much faster expectations around, how infectious this particular disease is and potentially how lethal it is. So that's something we've got to keep an eye out for and we'll know over the next couple of days. On a more positive note, we also saw the World Health Organization said vaccines will probably protect against severe cases of the Omicron variant, which is good news, but again, it is still early days. And we saw earlier in the week that Moderna gave us an update to say that they believe that it would take them between 60 and 100 days for them to be able to create a specific vaccine for this particular variant. So that's also potentially positive news. In addition, we're hearing from the scientific community that there will be a better read on this variant over the next couple of weeks in terms of current protections and more information on how infectious this variant is. And so let's hope that there is good news on that front as well. Finally, coming back to the OECD report, the downgrade in the world economy was due to mainly that Eurozone downgrade on the back of increased cases in the European countries. And so that meant, let's have a look at, we saw lockdowns, mask wearing, other people movement restrictions on unvaccinated sections of the populations is obviously going to have an impact. If they can't go out and spend, that's going to have an impact on those local economies. So what I wanted to do is take a look at Germany, which is the fourth largest economy. If you've been watching this news, you would have seen that they're experiencing a very severe fourth wave of infections. And so we take a look at some of the data from last week. On Thursday, the government introduced restrictions on unvaccinated citizens. They can no longer enter any non-essential businesses such as bars, restaurants, movie theatres. And they are also looking to restrict live sporting events to encourage increased rates of vaccinations, as they also now debate a mandatory vaccination policy for their citizens. Now, why are they doing this? Well, again, let's have a look at the data. We did see that their current vaccination rates, fully vaccination, sits at around 68% of their population. And in the last 28 days, they've recorded 1.3 million positive cases and 6,222 deaths from the virus. Now, only the United States was the worst country in terms of higher numbers on both fronts. Last Thursday, they saw 73,209 new cases and there were 321 people who admitted to intensive care. But here's the big number: 21% of their entire hospital beds throughout Germany are currently occupied by COVID patients. So obviously that is the risk in terms of what they're trying to address there. Now, this is having a major impact on the people. And obviously, you know, the new risk of Omicron could also see, if that is highly contagious, an even severer impact on infections, which could obviously lead to definitely a severe downturn when it comes to economic activity. Now, the other important news is that Germany is a huge exporter. Okay, so they're the fourth biggest economy in the world, but also a huge exporter. So from a supply chain point of view, the last thing we want to see is Germany in lockdowns where workers can't get to factories and do the manufacturing. So they obviously, that can be a contagion effect that will also affect the rest of the economy. So that's just something we want to look out for. Now, staying on COVID, like we've done for the last couple of months, we do take a look at the data. So we have seen over 266 million cases now reported of the virus in the pandemic. And that's 15.4 million new cases in the last 28 days. Unfortunately, the death toll continues to climb with 5.25 million deaths, an increase of 203,000 new deaths in the last 28 days. Total vaccinations administered at this time of recording is 8.2 billion doses, and that's 1.16 billion new doses in the last 28 days. In terms of global population that is fully vaccinated, we've seen that now move from 39% up to 44%. And again, those vaccinations reduce infections and obviously reduce hospitalizations, increase mobility, which increases economic growth. As the vaccine climbs up, the fatality rate, I should say, is declining. So this is the other good news. So the fatality rate over the whole period of the pandemic is 1.99. So meaning that every 100 people that get infected, 2 people are dying, but that fatality rate has definitely come down in the last 28 days. So we'll be talking more about that. Now, before we look at the past 28 days, let's remember that the world's leading scientists and health professionals told us what would happen. They said there will be more infections will be recorded, but more importantly, as vaccine rates increase and improved therapeutic treatments should ensure lower deaths as measured by the case fatality rate. So let's now have a look and see whether they've been right so far. So global infections have increased by 15.4 million new cases in the last 28 days. Now, compared to the previous 28 days, that was 11.4 million cases. So they were right when it comes to infection rates increasing. And, you know, we also know with the Delta strain that the R0 rate, so that's the number of people who get infected from the original infection, is around 7. Now, compare that to influenza, the R0 rate is around 2. So that's obviously that reproduction rate. So that's something to be mindful of. So, and we know with the Omicron that that's also potentially going to have a higher infectious rate around that as well. Now, let's look at the vaccines administered over the last 28 days. They've increased by 1.17 billion doses. So globally, we talked about it before, vaccination rates moving from 39% to around 45% fully vaccinated. So the big test is, has it saved lives? Total deaths in the last 28 days is still a very uncomfortable reading of somewhere between that 203 to 204,000 lives lost, which is absolutely tragic. But on a positive note, the last 28-day mortality rate has dropped from 1.68 down to 1.39. Now, that's obviously showing that more and more people, well, less and less people are dying from more and more infections. So the scientists and the health professionals are getting it right. The data is pointing in the right direction as to what they're telling us. Looking at the Australian numbers, we've got a terrific story here, really. Even though we've sadly lost over 2,050 lives across the whole pandemic, our case fatality rate sits at a terrific 0.68, having recorded 235 deaths compared to over 400 deaths from the previous 28 days. Now, that is on the back of our high vaccination rates. So we are definitely seeing, you know, our vaccination rates moving in our big population centres towards fully vaccinated of around 95%. And that's obviously having a terrific impact when it comes to that. And also case reductions are also declining. So we've had 22,000 less cases than we had from the previous 28 days, again, on the back of the people restrictions and the health advice and the mask wearing and all the things that have supported that. So that's a wrap on the COVID. It'll still show up in obviously the other economic news, but it's really important to understand that this is an ongoing situation and we do have to live with this, and that's what's causing some of the global economic uncertainty that we're also seeing play out around inflation and also the health matters as well. So turning our attention to the other global economic news, the other big news has been around the oil story. We have seen, effectively based on what we thought was going to be a strong reopening of the economies, global economies, we did start to see oil prices start to go very, very high. We also see that Europe and the Americas are going into their winter months. So that also puts pressure on energy and fuel and heating costs. And so we did see a spike in the oil prices. Now, what has been countered to try and reduce the pressure on the oil price was we did see the US government release access to its oil reserves to put downward pressure on prices. And then also last week, in a surprise move, we saw OPEC did have their meeting and they control basically the supply of oil around the world. And a lot of people thought that they were going to halve their $400,000 quota of barrels from January, but they didn't do that. They basically maintained this level. So they maintained guidance that they're going to be supplying 400,000 barrels of oil in January as previously suggested. Now, this is a smart move by all of them because they understand how fragile the recovery could be if the pandemic continues to create these groundswells of issues that we have around inflation and so forth. So reducing those input costs also means that it's going to be far better for the economies to be able to move through this period. And so if we're seeing a coordinated approach in terms of keeping the price of oil down, that's also going to have a positive impact on prices for input costs. So we also don't see that inflationary pressure coming through to the markets. All right, turning our attention to the United States. This was their big news story for this month, and that was around the higher interest rates are coming to the US of A. The US Federal Reserve Chair Jerome Powell, speaking at the House panel last week, warned that the risk of persistent elevated inflation has clearly risen. He stressed that policy will continue to adapt to keep rising prices in check, whilst reiterating that officials will consider speeding up the tapering process. When quizzed on the impact to the market, he said he didn't expect a winding down of asset purchases to disrupt markets because the Fed had already telegraphed this. So basically what he's saying there is that we're going to do what we need to do to be able to, get inflation, which from their point of view may not necessarily be transitory now, into check. And they're going to do that by effectively lifting interest rates and reducing their asset purchasing program that they've implemented. And it says here, the markets don't need much more bad news on the back of Omicron and the new pending interest rate rises. The US stock market is showing increasingly high levels of market volatility and the risk to the downside when it comes to share prices. In many cases, they still remain quite high in historical terms, the business valuations and share prices there. And we did see at the end of last week, a large correction in the markets once again, and also a large correction inside crypto markets going on from that. So that is definitely something to watch in terms of what's going to happen in the equity markets. There are jitters in play here at the moment. On the jobs front, weekly jobless claims for the week ending the 27th of November rose to 222,000, up from a revised 194 for that period. This is well below consensus expectations of 240,000 jobs to be created, but there's still so many job vacancies in the US right now, and with unemployment close to 4%, and annual growth rates of wages is currently reported at over 4.8% year to date. So again, good news story for wages growth, tight labour market. The Fed's tightening isn't coming too early, right? In terms of being able to to be able to taper, or increase interest rates to try and get that inflation genie back in the bottle. Retail sales rose 1.7% in October, beating expectations of a 1.4% gain, marking the strongest monthly gain since March. Sales were well above pre-pandemic levels, boosted by elevated savings and strong wages growth we mentioned earlier. However, again, looking ahead, the downturn in consumer sentiment on the back of all of these uncertainties around inflation, Omicron, and so forth, we'll probably see the peak of that spending for now as we start to settle down after Christmas. In terms of the ISM Manufacturing Purchases Index, the PMI for November rose 0.3 of 1 percentage point to 61.1. The figure indicates expansion in the overall economy for the 18th month in a row after a contraction in April 2020. Now, this is the interesting reading here. The report suggests that manufacturing sector remains in demand-driven supply chain constraint environment. So where some indications of a slight improvement in labour and supplier delivery, but all segments of the manufacturing economy continue to be impacted by very low raw materials and capital equipment lead times, continued shortages of critical lower tier materials and higher commodity prices and difficulties in transportation products. So hence, this is why the US is challenged with inflation right now. So it's an interesting story for the US and interesting also on the back of the OECD thinking that they're in pretty good shape overall. Looking to China, the world's second largest economy, the producer price index rose 13.5 over the year to October, the highest rate on record after a 10.7 annual growth rate in September. China's factory gate prices were fueled by imported inflation and tight domestic supply for energy and raw materials. Continuing on, the rapid rise in producer price inflation is also beginning to flow to consumers. The consumer price index increased by 1.5% over the year to October, the fastest pace since September 2020. The result provides further evidence of building inflation risk as producers pass on the effects of rising commodity prices, energy shortages, and supply chain bottlenecks. And you can see this as an emerging pattern in the high input costs causing price inflation, not only locally in China, but also in regards to the exports that they're delivering out. Overall, the Chinese economy showed signs of stabilizing in October. Industrial production was up 3.5% on the year earlier, following a 1.3% rise over the year in September. The growth comes alongside easing energy shortages. Power supply is improved by 11.1% on a year ago. So that's pleasing for internal costs in China. Retail sales beat consensus expectation, rising 4.9% over the year to October, following a 4.4% annual increase in September. Finally, of interest to me and the property side, media reports suggest that China's financial regulators told several Chinese banks to issue more loans for property projects with the aim of easing liquidity constraints without restarting any housing speculation. Now, this will be interesting to see how they're going to be able to balance that out, and we'll see that sort of play out in time. In terms of looking at the Eurozone, GDP growth has finalised at 2.2% for the September quarter, in line with preliminary readings. The quarterly reading brings the year-on-year GDP growth to 3.7%. Consumer spending was solid as people returned to the shops and restaurants, and tourism picked up with the increased cases of COVID that we just talked about earlier. This is definitely going to have an impact on consumer spending over the shorter term. So good results at the back end of their summer, but then obviously moving into autumn and now into winter with those restrictions and those spikes in the fourth wave over there, that's going to play out. Unemployment fell to 7.3% in October, down from 7.4% in September. The outcome was in line with consensus expectations. The number of unemployed people fell by 64,000 to 12 million. Annual CPI inflation was finalised at 4.1% in October. It's the highest level on record, in line with preliminary readings. This follows a 4.3% reading in September, the core measure reaching 2%. The bulk of the increase was driven by rising energy costs. Now, the final outcome of consumer confidence in the euro area in November remained unchanged at negative 6.8. There were also confidence measures for the economic and industrial released for the month of November. Most of those measures softened. The economic confidence index fell from 118 in October down to 117.5 in November. The industrial confidence index fell from 14.2 in October to 14.1 in November. The service confidence index bucked the trend and improved in November, rising 18.4 from 18.0 in October. Now, the Producers Price Index, the PPI, which measures changes in the selling price received by domestic producers for their outputs, rose by a staggering 21.9% over the year to October. Now, this was even above expectations of a 19% increase. The monthly growth rate was 5.4%, almost twice as high as the revised September outcome of 2.8%. Now, energy prices increased were the major contributor to this gain. The ex-energy construction measure rose by a relatively more muted 8.9% over the year and 0.8 over the month. So what is this telling us? It's basically telling us that there are some headwinds in the Eurozone on the back of the pandemic wave of lockdowns, cost inputs, energy prices, and that's again why you saw the OECD start to downgrade their view on the Eurozone. And if you think about the Eurozone combined, it's obviously a very, very significant area of economic growth for the global economy. Now, that's my wrap for the year for the outbound, the countries and the global economic story. Let's turn our attentions back home, starting with the RBA news. So today at their December meeting, the RBA Board kept the cash rate on hold at 0.1%. No surprises there. They're still maintaining their focus on wages growth, and rightly so, in my opinion. In the minutes of last month's RBA Board meeting, there was acknowledgement that it was plausible that the first cash rate will come potentially in 2023, or still the 2024 rhetoric that we've heard from the governor for such time. But this has been continued to be putting pressure in terms of rate hikes as early as 2022, because the future markets are telling us that they think that there will be a rate increase as early as August of next year. Now, we'll have to wait and see who is going to win this battle, given what will be the final trigger. Will it be wages growth, or will it be inflation that will force the RBA's hand? Speaking of the inflation story, Governor Lowe last month outlined his case for inflation in Australia only being transitory and not being more permanent. The governor indicated that inflation outlook for Australia is different than many other advanced countries for a few reasons. Firstly, the starting point of inflation and wages was lower in Australia. So we had lower inflation, lower wages than the rest of the world when we started to have our economic pickup. Secondly, labour market participation rebounded very quickly in Australia, unlike some other countries, which puts less pressure on wages because productivity grows. And if you've got those staff already employed, there's no labour shortages. Finally, the impact of supply chain disruption and energy price shocks were less pronounced in Australia. So that was his thesis, his argument, why he still feels that inflation is only transitory and won't be more embedded in the Australian economy, as we're starting to see in the US and potentially the Eurozone's economy. Again, it will be wages growth or inflation concerns that will see the cash rate move, and when this will happen. One thing is for sure, with an election, a federal election early next year, we are talking about timetables of March through to May. It's clear that there will be no rate rises in the first half of next year because of that election that's going on. In other interesting news coming out of the RBA is around the knowledge and commentary around crypto. I mentioned this earlier when I went in, leading into today's update. Cryptocurrencies and the whole, distributed finance area. So let's firstly talk about what Michelle Bullock, who is the Assistant Governor, said. She indicated the RBA was considering the creation of a central bank digital currency. You're going to have to get this abbreviation, a CBDC, for use in wholesale markets. The idea is this would allow commercial banks to reduce transaction costs and risks by creating a system that settles transactions instantly via the new Web3. And so if you don't know what the Web3 is, this is where the new technology infrastructure is being built to support blockchains, distributed ledger solutions for digitizing a range of things, assets, creating cryptocurrencies, and also making payments. So that is what, when people refer to Web3, that's what they're talking about. Now, it's good news to see the RBA is looking to explore these new opportunities, which in the past has been a little bit of a Wild West in this particular area around valuations and people making different types of cryptocurrencies and all trying to cash in on it. So that's the first instance we saw of the RBA taking more interest in this particular space. The second time was where we heard separately from the RBA's Tony Richards, who warned cryptocurrency investors over excessive hypes around the asset class. He cautioned that there were plausible scenarios where much of the price increase over recent years could be unwound. The RBA expects global central banks will establish control over digital finance by issuing a new form of digital bank and digital money called central bank digital currency. There's that abbreviation again, CBDC, relating back to Michelle Bullock's point. Now, I realize for the hardcore crypto followers who might be listening in or on this update, the whole idea of crypto is around decentralizing money and making sure that the central banks didn't have a way to play in this particular space. But given that they are taking an interest in this area, it's rightly or wrongly, you've got to consider that as part of what you're looking at from an investment point of view. Will this be net positive or net negative? I think one thing's for sure, that overall, not all of these cryptocurrencies are going to be successful. So you want to be very, very careful in this space. What you don't want to be betting is your financial future on any investments you are making into crypto. That would be silly. So it's an important thing. So good to see the RBA playing in this space. Let's see what further comes of those discussions, not only for the RBA, but central bankers around the world when they start to look at these crypto solutions as part of this new Web3 discussions that are going on. Looking at the GDP for the quarter. So last week's GDP numbers were another impressive example of a resilient Australian economy. We did see GDP only shrunk by 1.9% in the September quarter compared to the consensus forecast of 2.7. Now, this is still the third largest fall on record, because the biggest two economies, New South Wales and Victoria, were in lockdown during this period. The result can mainly be attributed to falls in household spending in the lockdown affected regions of New South Wales, Victoria and the ACT. To give you some sense of this household spending, it fell by 8.4% collectively in those regions, but rose 0.7% for the rest of Australia. Now, interestingly, household gross income spiked 4.6% for the quarter, the fastest in nearly 13 years on the back of continued government support in some areas. And it's pretty clear that consumers and business have also become adaptable to living with lockdowns in the knowledge they are short-term events. And as such, consumers are building, and businesses have worked out a way of doing business even through lockdowns and these difficult times. Now, the big fall in household spending showed up in transport services, negative 41%, hotels, cafes and restaurants, negative 21%, arts and recreation, 12%, and accommodation food services were the hardest hit. So just understanding all of those types of things. We can also thank the miners and the agricultural sector for the outperformance in the September quarter. They were the ones that made the result look a lot better than most of the economists believed it would be. As the reopening of Australia on the back of the high vaccination rates, it's very clear the economy recovery is going to bounce back in the September quarter. And that bounce back is now underway, with most economists predicting that the trend growth in 2022 and beyond, with the only caveat being, yep, you guessed it, the COVID pandemic and the increased health risks around Omicron in terms of what's going to happen there. The other important data read out of the GDP numbers last week was the household savings ratio. It once again surged to nearly 20%, to be just shy of the record highs posted last year. Now, you combine households flush with cash and feeling more optimistic about their future, and you'll get increased spending. above trend, and this will create obviously above trend growth in the economy if that momentum continues. The unemployment story, the unemployment read for October was 5.2%. That was up from 4.6 on the back of the September lockdowns for New South Wales and Victoria. So unemployment declined in October by 46.3 thousand jobs in the month. The participation rate lifted as more workers returned to the labour market looking for work in the knowledge that Sydney and Melbourne were about to reopen. Nationally, hours worked eased by just 0.1% in October, which is a great sign that the economy is going to see more productivity by the number of hours worked going forward. So that is, again, a positive story for the Australian economy. Job ads also showed clear levels of strong job demand. In the October reading, they remain around their highest levels in decades. This is supported by the recent job ads from ANZ. A result yesterday showed a very strong 7.4% month-on-month rise in November. And that's on the back of a 6.2% gain in the prior month of October. So that is also pretty powerful. Now, on the back of this data, most economists are forecasting unemployment will go as low as 4% into the end of next year. And again, it's a really positive sign for wages growth and a perfect segue into wages growth. When we do look at the wages growth number, we also need to be mindful of the 3% target the RBA is looking to get. So overall, the signs of life are now appearing in the data for wages growth. We saw wages growth grow by 0.6 in the September quarter to be 2.2% higher over the year, taking the annual growth to a 2-year high. Labour shortages are putting more pressure on future wages growth. In terms of private sector wages, rose 0.6 in the September quarter to be 2.4% higher over the year, the strongest annual rise since late 2014. Public sector wages only rose by 0.5 in the quarter to be up 1.7% over the year. And that is because of the removal of the wages freeze that was occurring in the public sector. We should start to see that public sector wages growth will also start to lift in the data in 2022. Consumer confidence remained strong in November and was largely unchanged in October following the easing of lockdown restrictions and continued progress on the vaccine rollout. Melbourne Institute's monthly consumer sentiment index was up 0.6 to a reading of 105.3 in November. That's following a decline of 1.5% in October and is above the long-term average, which is a read of 101.3. Consumer sentiment has been resilient in 22, supported by the growing comfort in living with COVID, supported by vaccine uplift and reducing the chronic health risks to our society. Whilst positive overall, one metric that we did want to highlight here was to keep an eye on was the fall of 5.2% in responding to a mortgage, highlighting the concern about future interest rate rises. So people's confidence around mortgages and mortgage repayments is now starting to show up in the consumer confidence data. Looking at the weekly read of consumer confidence from ANZ Roy Morgan, the last week of November, we were trying to get a gauge of whether we saw Omicron in there. It's not quite in there yet. So we did still see a reading of 106. And remember that 100 is baseline. So anything above that is people are more optimistic or positive than negative in regards to what's happening in the economy. Retail spending jumped 4.9% in October to post-lockdown pent-up demand was released. These were the numbers: 13.3% surge in New South Wales post-lockdown, 3% in Victoria, because we down here in Victoria opened up later in the month. So our data next month would be even stronger. And the ACT 20.2% up. Categories, clothing, footwear, personal accessories up 27.7, department stores 22.4, cafes, restaurant, takeaway and food outlets up 12.3, household goods 4.5, other retailing 2.2, and food spending declined. So we didn't have to buy all those takeaway and Uber Eats. Retail sales appear to be in good shape going forward on the back of higher household savings, which we mentioned earlier. There's still plenty of international travel hesitancy as well. And that means that the 70 billion that Aussies would normally spend offshore, if people aren't necessarily going to jump on a plane just yet, they'll need to find a home for that money, and that will probably appear in terms of their local spending. Business confidence was higher in October again on the back of lockdowns ending in New South Wales and Victoria. Confidence jumped 11 points to be plus 21, not far off the record high of plus 24 in April of last year, as conditions rose by plus 6 to be plus 11. In trend terms, confidence is higher in New South Wales, followed by South Australia and Queensland. Conditions are strongest in WA, Tasmania, Queensland, likely reflecting that these three states have had relatively low impact on the health restrictions. Coming now to the final run home, we're talking about housing finance and just the property story in general. We've got household lending, excluding refinances, fell by 2.5% in October, led by a continued decline in new owner-occupied lending. New loan commitments have fallen in 4 of the last 5 months, as the housing market appears to be taking somewhat of a breather. More to talk about that shortly. New owner-occupied lending fell 4.1% to its lower level since November of 2020. Lending in this segment has dropped for 5 straight months and is down 15.4% from its peak in May 2021 on the back of the government incentives. Here's the interesting story. New lending to investors continues to grow. Investor lending grew by 1.1% in October to its highest level since April of 2015. Investor lending has grown for 12 consecutive months by 89.6%. And as investors look to place their money in something other than the banks, where they're getting very, very poor returns. Closing out the other big market segment here, affordability constraints continue to weigh on first home buyers. New loans to first home buyers fell 3.8% in October, taking the string of monthly declines to 9. The shares of new homes to first home buyers has fallen from the peak of 36.5% in January this year to 30% in October. And this is the lowest level since mid-2019. So we saw a big forward push of those first home buyers coming into the market. And now we're seeing that this lag effect that's coming off that. Looking at building approvals are now back down to pre-pandemic levels following the closure of the home builder incentives. That's why they sped high during that period. Approvals fell 12.9% in October, which is the largest monthly fall since May of 2020. The overall fall in October was driven by a 37.5% fall in multi-density dwelling approvals. That's apartments and townhouses. Now, this does sound like a big fall, but you've got to remember with these big constructions, they do bounce around from month to month. So I wouldn't be reading too much just into that single number there alone. In terms of private sector house approvals, which is your sort of freestanding houses, actually increased 4.3% in October, showing potential signs that we might be back to some normality levels post the home builder stimulus. We should get more clear idea of new private sector housing approvals over the next 6 months, given they remain 24.6% higher than pre-pandemic levels. Let's look at prices. Let's look at where the property market is right now, and then let's have a little bit of a sneak peek in terms of where they're going to go in 2022. So looking at the CoreLogic numbers, we saw dwelling prices record another month of solid above average growth of 1.3% in November. However, the monthly pace of growth has slowed from a peak of 2.8%, which was the peak in March of this year. In fact, monthly price growth was the softest since January of this year. In annual terms, dwelling prices surged 22.2% in November. Annual price growth has accelerated for 12 consecutive months and is at the highest level in 32 years. So generally speaking, what has been driving this growth? Well, obviously, FOMO, fear of missing out, is still live in the marketplace. We've got cashed up investors, cashed up owner occupiers, historically low, cheap money. That's all been a catalyst for bringing on that strong demand. The question is, will that continue into 2022? Let's take a look at the major capital cities, and I'll do a summary here. So you saw Sydney for the month, 0.9% increase, annual increase of 25.8. So you're looking at a total return of 28.8. Median value is $1,090,000. Melbourne, monthly gain of 0.6, annual gain 16.3. Overall return, when you factor in yield, 19%, median house price 788,000. Brisbane is white hot at the moment, 2.9% increase in the month, 7.4% for the quarter, annual 25.1, overall return 29.8, median house price 662,000. Adelaide, also a very hot market, 2.5% for the month, 6.5 for the quarter, 21.4 for the annual, 26.5 including yield returns, median house price 558. Perth, only 0.2 of 1% growth for the month, 0.4 for the quarter, annual return 14.5, total return 19.5, median house price 528. Hobart, another strong month, 1.1 for the month, 5.5 for the quarter, 27.7 for the annual, and 33% overall. Median house price in Hobart, remember this, $676,000. I'm coming back for Hobart. Darwin, -4 for the month, 0.2 only for the quarter, 16.7 annualized, really high yields up there, so 23.5. Median house price in Darwin, 493,000. Canberra, solid month, 1.1, 5% for the quarter, 24.5 annualized, including yield 29.1, median house price 882,000. So combined capitals 1.1 for the month, and you're looking at an overall return of property values of around 21.3%. Combined regions really strong again, 2.2 for the month, 25.2 annualized, and also some strong yields there showing a 30.4% overall. Median regional markets now 527,000 for property. So it's clear that some markets are hotter than others, highlighting Brisbane, highlighting Hobart, highlighting Adelaide. Now, I support the fundamentals in the Brisbane market. I support the fundamentals in the Adelaide market, but right now I can't support the fundamentals in the Hobart market. They just don't make sense to me. I think that Hobart now is a market that has the most risk of being overvalued and a property market correction in that particular market. Now, they have a large amount of slated supply coming through. So you're going to see supply increases coming in. You're also going to see a lot of people stretched in that particular market from an affordability point of view. And considering, to give you some context, you're looking at Perth, which has the second highest disposable income in Australia, compared to Hobart, which has one of the lowest disposable incomes. And you've got a Perth median house price of 528,000, and you've got Hobart, which is a tiny market, at $676,000. So I suspect there is going to be some risk in that market, and I suspect prices will come off in that market from a capital city point of view worse than they will in other areas, especially once we start seeing interest rates kick in over the next 12 to 24 months. So be careful if you are owning property in that particular market. You may want to get some advice about what your next move in that particular market is. Briefly looking at 2022, so positive news story here. We're going to have good economic growth. Omicron hopefully doesn't get a hold of us and we have any future restrictions. If it doesn't, then we're in really good shape. We've got economic growth. We're going to have low unemployment. We're going to have wages growth. Yes, we will see interest rates start to moving up over the next year or two in terms of what that looks like. So, but a really positive story. You've got immigration coming back in. So you're going to have strong demand for housing. You're going to have strong demand for rental accommodation as those new arrivals start to look for a place to live. That's on the positive side. The headwinds are around this. So we have seen a real strong increase in supply. A lot of people holding off to put their property into the market. And we're definitely starting to see in some markets like Sydney and Melbourne, auction clearance rates are starting to come off and supply is still there. So less demand, more supply. So it's definitely lost a bit of its mojo. Now, whether that recovers or returns next year is still to be seen in terms of our autumn selling season. But right now, it's very, very clear that those markets have second and third tier properties that don't have that same power to push values higher. So I'll potentially start to see a slowing of those particular markets. Now, slowing from a very, very high rate of monthly growth. So you still might see growth in those particular markets, but just not at the level that we've seen them at in terms of double-digit growth. There's also obviously talk about the sentiment's definitely changed on the back of interest rates potentially also being affected for next year. And we've got a federal election, which could also change the dynamics in terms of the direction of the economy, depending on who's in power. So there's a lot to be considered in terms of the property market. And I'll have more to say about that with Bryce Holdaway on the Property Couch podcast that we do. So if you're listening to that as an Empower Wealth client, check that out when we start to talk about the property market in more detail in February after we finish the summer series. So that's it for this month. As we finish off the festive season, I'll take a break. I'll be back in February as per the RBA announcements as well. And so, I want to just pass on this message to say I wish you all a very, very Merry Christmas and a happy and prosperous New Year into 2022. And remember that knowledge is empowering, but only if you act on it. Bye for now.